From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for May 8th, 2026. Let's see what's happening this weekend. The Brewers battle the Yankees at home all weekend. The Scrappy Classic 5K takes place Saturday in Humboldt Park. It's a scenic run, but let's be honest, the real draw is the pizza buffet waiting for you at the finish line. And the New Fashioned is hosting its first ever cheese swap. The premise is exactly what it sounds like. You bring a wedge of cheese and you leave with a different one. You can also sample over 50 beers on tap while scouting the room for that perfect hunk of Gouda. Now, speed limit signs aren't usually all that captivating, but the Outagamie County Recycling and Solid Waste Facility is trying a new tactic. They've officially set their ground speed limit to 17.3 miles per hour. The goal is to break drivers out of that autopilot fog by giving them a number so specific they'll have to actually look at their speedometer. It's an interesting psychological experiment. It does make you wonder about that margin for error, though. If you're caught doing 18, is that like a formal warning, or do they just admire your rebellious spirit? Next up, fishermen in Cape Cod caught a rare split-color lobster. The two-tone crustacean has the usual brown color on one side of its body and a bright orange on the other. Because of the 1 in 50 million odds of such a pattern, the lobster was spared from the boiling pot and has been safely relocated to a local aquarium to live out its days as a bit of a celebrity. And finally, San Francisco has a new celebrity in town, nicknamed Chonkers. He's a sea lion who has allegedly migrated down from the north and significantly outweighs the local California sea lions. He's become a bit of a local sensation, with one tourist describing him as being the size of a Volkswagen. Now, Chonkers must have missed a memo there. Looks like he came to San Francisco without wearing any flowers in his hair. On the show today, we've got Kendall Bauer, and with a look back at the week, here's Kyle Tetting.
Well, thank you, Jason, and I can confirm it's worth checking Chonkers out. He is quite the sea lion. Quite the markets this week. The Nasdaq up 4.3%, really strong rally in particular in the tech sector. The S&P up 2.1%, and the Dow Jones Industrial Average largely flat on the week, down 19 points, but in percentage terms, 0.0% change in the index. Not much to pay attention to there. Really, the market's being driven right now by a return to a lot of the AI and a lot of the technology stocks. Kendall, hard not to start this week looking at just how exceptional of a run it has been for stocks. I wrote for our newsletter a month ago. We'll have another one coming out this afternoon, but I wrote for our newsletter a month ago that investors' expectations were going to shift from strictly looking at the war back toward the things we always care about, earnings and interest rates. And sure enough, we've had a heck of an earnings season. And it seems to be that investors have kind of come around to this idea that it is earnings that are supporting stocks, at least near term, and hopefully as we look ahead.
Yeah, one of the strongest quarters, I think, in almost 20 years. We still have maybe 35, 40 companies set to report, but so far it's looking like full quarter earnings growth could be pushing up into the high 20s, which is, I think, the last number any of us would have guessed or any investor would have guessed a few weeks or a couple months ago, given that a new Middle East conflict had just erupted, energy prices screaming back up high. And it's a good reminder that the market doesn't always make sense. It is, I think, embedded in every one of us here that fundamentals drive markets in the long run. And this is just a great example of, watching that play out.
Well, I think it is that strong reminder that investors are not focused on what has happened. They are not focused on what is happening. They are focused on the expectation for where things are headed. And everything we do when we look at the stock market in particular is wired toward what do we think is the next thing that's going to drive this? And I think investors, for better or for worse, for right or for wrong, have looked past the Iran war and said, well, there's a lot of really good stuff happening in corporate America, and you can blame that or ascribe that to a lot of different things. I think one of the biggest places to look at, though, is just how much money is being spent on artificial intelligence, on data centers, on this warehouse space that at the end of the day is not imaginary. It's not as if we hope this will happen. It is hard money being spent and hard money committed to what will be spent down the line. And so when we look at Caterpillar reporting earnings a couple weeks ago and talking about how much pent-up demand there is for their machinery, well, yeah, okay, maybe not the first thing you think of when you think of these data centers, when you think of all the build-out that's necessary, but none of it happens without tractors. Likewise, we've gotten some immense news stories coming out about what's happening with Intel, with Apple, with many of these names that are so closely tied to technology, even beyond just artificial intelligence specifically, but businesses that have piles and piles of cash often, creating partnerships, making deals, finding ways to build out what ultimately is years and years and years of spending. And again, from businesses that have it, we draw this parallel, I think, often to the tech bubble of the late 90s into early 2000 and go, well, we're down the same path now, right? That there is this euphoria over artificial intelligence that will ultimately lead to some kind of end. There are some pretty significant differences. A good portion of the tech spending that took place in the 90s was just to get over the hurdle of the year 2000, to get over that Y2K bubble. If you're Delta Airlines and you need to transition your system away from, well, we can't handle going back to 000 on the clock, now we need to get to some new format, some new way of thinking. Well, yeah, you're going to spend hundreds of millions or billions of dollars to make sure that on January 1st, 2000, your systems are still operating. AI is a little different, and these data centers are a little different because there isn't that hard end to this spending. And in many ways, spending a little just means you're going to have to spend more later to keep up. And so I think what we're seeing from tech businesses is, how do we stay ahead of China? How do we stay ahead of our competitors? How do we make sure that as we figure out how to monetize these things, we have these opportunities? And Kendall, one of the problems that has come out of that is that there's been no shortage of creation of investment opportunities, right? That especially with the prevalence of the exchange-traded fund, a powerful tool, a wonderful tool, all kinds of really great things to keep in mind, that all of a sudden we're creating these vehicles that are sometimes very narrowly focused, sometimes maybe have pitfalls we don't understand. And so potentially a good reminder for investors that just because we can do something doesn't mean we should. And in many cases, a lot of these ETF tools maybe aren't completely understood.
Yeah, a great article in the journal this week about more and more active ETFs coming to market. Something like 1,100 ETFs launched last year. And I just read today that they're on pace for similar numbers this year. And I think an important distinction to understand, not all ETFs are created equal. ETFs came to rise I think early on because many of them were passive focused, meaning they tracked an index, and because of that passive nature, they had very low cost. And that was very attractive to certain investors. And, FITS has a place in a portfolio. And now what we're seeing is a shift to a more active approach, which is more akin to what we expect or see with mutual funds that have fund managers and are actively trying to outperform their benchmark. And with that active approach comes more expenses. And so not all ETFs are what people used to talk about, this idea of passive investing or cheap indexing. That still exists, but now new products coming out. And again, some of them are great. Some of them can fit specific roles in certain portfolios, have specific use cases. But you have to be careful and understand, number one, what it is you're buying and the cost associated with it, because they're not all created equal. It's not just this simple low-cost product that it kind of came up as.
Yeah, what I love about the conversation and what I so often hear from clients is, well, now that there are all these ETFs, let's use them. And there are all kinds of pitfalls, first and foremost, to transitioning to them. But in a lot of cases, what these exchange-traded funds or exchange-traded products are doing is identical to what we already have in our portfolios. And so, yeah, great, this new really shiny wrapper is put around a piece of candy that you already have in your portfolio, just in a slightly different wrapper. Why go through the expense, the cost, the potential tax implications of making that change if you're not actually getting anything different than what you already own? And again, it's worth exploring what those options are, but it isn't, well, okay, now it's available, we should use it. I think we have to have a better understanding of what it is that's available. You know, Kendall, no shortage of economic indicators to look at this week. You know, the ones that have stood out to me the most, really the labor market. We got news at 6.87 million job openings. We got an unemployment rate this week, 4.3%. We've got strong, maybe not great, but stronger than inflation level wage growth. And what do you learn as you look at some of the labor data this week about maybe the overall strength of the labor market?
Well, I think it's a good reminder, too, that not this idea that everything is kind of falling apart around us with maybe some geopolitical headlines steering the ship for the better part of the year, and the fear of higher energy costs leading to higher inflation. Good reminder that, hey, wait for some of the data to start trickling in before coming to these conclusions. Unemployment's still relatively low on a long-term basis, 4.3%. Big jobs number coming through this week, I think beating expectations by a fair amount. 115 jobs added for the month of April. And you still have decent wage growth. So yes, inflation's still a concern. It's something that we think about and we keep a close eye on with the increase in energy prices. But I think for the most part, the economy is humming right along.
And what's interesting to me is how weak consumer sentiment has continued to be. We got a preliminary reading on May consumer sentiment from the University of Michigan, near some of the lowest readings we've had in a while. And this data is going back to the 1980s. Used to be that those numbers were far, far higher than they are today. I think more recently, the last few years, we've seen some pretty pessimistic consumers overall. Haven't seen a meaningful shift in spending patterns, haven't seen really any kind of tail off in what that means more broadly for our economy. But it is interesting that by and large, consumers don't feel great about the current conditions.
But they keep spending. And this is what we've talked about this quite a bit on here over the years. And it's why I think you still have to take some of these surveys with a grain of salt. They can be helpful in helping us kind of build a picture of what's going on. But there's been this pattern of the consumer, complaining about costs going up, yet it's not reflective necessarily in their spending. And that could change. But we've seen this kind of ongoing pattern of, consumer sentiment going down, but consumer spending staying steady, or in some cases even going up in the other direction.
Yeah, and we saw that in the consumer credit number this week, up 3.2%. No signs that the consumer is pulling back on their willingness even to swipe with a card. And so I think it does paint a picture of a consumer that clearly in some areas, and particularly with some meaningful wealth and equality, we're seeing some struggles with higher gas prices. That, again, is reflected in the consumer sentiment surveys. But again, to your point, by and large, spending, not afraid to continue to purchase. And when they look at what they expect for the future, well, still expecting inflation to run a little hotter than historically average, but some signs that at least what they're looking ahead to is better than the way they feel about what's going on right now. There was a pretty interesting article, I know, from one of your more favorite authors in the Wall Street Journal, Jason Zweig, looking at exactly what we are dealing with right now when it comes to a pretty immense run in the market. I was looking at data since March 31st. On a sector-by-sector basis, the best performing sector since March 30th, the information technology sector, it's up nearly 25% just in the month of March. And yet on the year, it's right in line with broader markets, right in line with everything else we see. And I think there's this tendency then to look at a recent stretch of really strong performance and go, well, there's a bubble forming and it must be popping soon. And I think Zweig pretty rightfully points out that maybe we need to be a little bit more careful about how willing we are to forecast when that bubble's going to burst.
Yeah, and how often we forget how badly some of those companies and even some in the Mag 7 got beat up the previous 2-3 months before that. And I think, yes, it's impossible to call when you're in a bubble. And it doesn't mean, hey, now's not a good time to maybe take some gains. We've seen a great rally back in markets the past few months. And I don't think by any stretch of the means are we in the clear from a volatility standpoint this year. We still have a midterm election coming up. But yeah, I don't think it doesn't have to mean that we're in a bubble because the tech sector is ripping back up in a positive direction after some pretty hefty losses. And there's still parts of the market, tech software in particular, some companies that are still, getting beaten up on the year. So I think for all the bubble talk, there are signs that we tend to see historically: euphoric spending, people chasing high risk things for little bits of returns, other little indicators that aren't necessarily popping up at this point. But in the same vein, it doesn't mean that it's not a good time to pair some, take some gains if you have a reason to, or if you have cash needs, or if you have an RMD, or you plan to do charitable gifting. But I think too hard to call.
No, I think that's fair. And I'm one of my favorite market quotes from John Maynard Keynes is talking about this idea that, things can stay this way far longer than you think they can. The quote is, markets can remain irrational longer than you can remain solvent. And the thinking is that you can know exactly what's going to happen. You can have every data point that supports it. But if you're wrong even a little bit about when it's going to happen, it can hurt just as much as being wrong about everything else. And we can look at the markets and go, well, at 21.3 times forward earnings, and by the way, a pretty strong earnings forecast, but at 21.3 times forward earnings, stocks look pretty expensive. And it wouldn't shock me if they came back to earth a little bit, especially after the recent run. To see them trade sideways for a little while would be healthy. But at the same time, to assume that every other investor who should have the same information, the same data in front of them, is suddenly going to decide, well, today is the day, and that lines up with what you think, well, markets can remain irrational a lot longer than you can remain solvent. And so I think the answer for us has always been, let's pick a path that we're comfortable with. Let's pick a path that gets us not just through this next bout of volatility, and there'll always be the next bout of volatility, but let's pick the path that gets us 3 years, 5 years, 10 years down the road. And, your point about, hey, let's sell some money for those charitable distributions. Let's sell some of that great rally and set it aside for the cash we know we need to send you. Well, last summer we were talking about, hey, stock prices look great. Maybe we should be trimming a little bit into that. And I bet a lot of that cash has made its way into the economy now for our clients who I know are going on trips and improving their homes and giving it to their kids and grandkids. But at the same time, it means, okay, we probably got to do the same thing again. And I think spot on that, we better make sure that we are thinking ahead because it isn't always going to be this good. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.